Alright team, today we're digging into brand new Redfin data showing a record surge in homebuyers canceling contracts this fall. Nationally, over 15% of deals fell apart in September, up from 13.6% a year ago, and in some markets cancellations are near 20%. Think Tampa, San Antonio, Atlanta, Orlando, Fort Worth, Riverside, Fort Lauderdale. Sellers are getting ghosted, and it's one more sign the market is tilting toward buyers as we head into late 2025 and into 2026. Why are buyers walking? Two big reasons. First, a confidence problem. Prices still feel sticky and the market is volatile. Second, sellers are clinging to pandemic-era pricing. When buyers go under contract and request inspection credits, too many sellers dig in and the deal dies. Even earnest money is being sacrificed in some cases. Layer on a jump in new listings, highest in 5 months, and it's a classic setup: more supply, fewer committed buyers, and rising leverage for anyone willing to negotiate. Rates have eased off recent highs, but buyer demand hasn't come back. Redfin's latest tracker showed pending sales down about 0.7% year-over-year through October 19. That's despite multiple Fed cuts this year and another likely on deck. Meanwhile, new listings rose 4.6%, the biggest gain in 5 months, as sellers try to catch a lower rate bid that just isn't there. There are reportedly around 500,000 more sellers than buyers nationwide. Translation: the pressure is on the sell side. Let me show you how this plays out at the street level. In Atlanta, I found a 3-bed, 2-bath, about 1,500 square feet, listed at $250,000 with a monthly payment estimate around $1,400. The seller cut from $450,000 last September to $250,000 this September. That's a $200,000 price drop. Estimated rent is about $2,000, a compelling rent-to-buy spread. This is what motivated price discovery looks like. Flip over to Tampa, zip 33604, one of the highest cancellation markets. A 4-bed, 2-bath, 400 square foot home bought for $325,000 in early 2023 is trying to resell for a profit. Original list $399,000, now cut by $50,000, but still above the 2023 purchase. Values in 33604 are down around 4-5% year-over-year, with additional downside likely. In a neighborhood facing more supply, more cancellations, and softening comps, that seller needs to cut further, maybe $30,000, $50,000 to meet the market. Houston example: newer 3-bed, 3-bath, about 1,700 square feet, listed around $375,000. The seller is also advertising for rent at $2,500. If you run the buy versus rent math, with 20% down, 6 is on the rate, $7,500 annual taxes, and $1,500 insurance, you're roughly $2,700 all in to own versus about $2,900 to rent similar nearby. That narrows the gap. On paper, buying can work, but watch the zip trend. If the area is down double digits year-over-year with another 5-9% forecasted decline, you should negotiate hard. $25,000, $30,000 off list can flip the math and the risk. Bigger picture: national existing home sales bounced month over month, but we're still way below pre-pandemic norms. Think roughly 4.0 million annualized versus 5.5 million pre-2020. Demand is in the basement. What's changed is supply. Active listings are now around 1.1 million, up more than 50% from 2 years ago and nearing pre-pandemic. That's finally applying consistent downward pressure on prices. My national view for the next 12 months: a mild decline on average, with big regional differences. Winners and losers: the Northeast and parts of the Midwest still look relatively firm. The most downside risk remains in Florida, Texas, parts of the Mountain West, and some western metros with soft rent growth, heavy new supply, or insurance shocks. We're already seeing year-over-year price declines in 15+ states, led by Florida, Texas, Colorado, and pockets of the West and Southeast. Quick hits around the map: Austin is in a bona fide reset, down over 20% from peak and still slipping. Good buyer leverage. Dallas, Fort Worth, mixed by suburb, leaning negative with more supply and longer slump. Nashville, especially East Nashville, marginal declines with more pressure ahead, negotiate. Seattle, sticker shock persists, rents are far below buy costs in many areas, keeping demand muted. Some sellers are now taking losses to trade out. Phoenix suburbs like Chandler, Gilbert, inventory up, price cuts elevated, and DOM stretched. Buyers market dynamics. Florida broadly declined, spreading from southwest Florida through Tampa Bay and into Orlando and even South Florida. Insurance pain and rising inventory are the accelerant. Northeast metros like parts of New Jersey and western Pennsylvania still relatively tight, modest price gains and shorter DOM less advantage to waiting. On the supply side, you're seeing three key seller behaviors: price cuts and concessions, rate buydowns, closing costs. Delistings in some Sunbelt metros when sellers don't get their number. Rising refi and ARM activity as owners try to improve cash flow or tap equity without selling. And remember the buy versus rent rule of thumb: when it costs 50–80% more per month to own than rent, equivalent entry-level demand wilts. That's what's freezing out a lot of West Coast and Sunbelt submarkets. Alright, let's zoom in on Texas because it's the bellwether for the South and it's showing the clearest cracks right now. Texas prices are down roughly 3.2% year over year, with the median around $331,000, over $70,000 below the US median. Austin leads the declines at about 6.4%, then Dallas around 4.1%, San Antonio 3.5%, and Houston 2.8%. Inventory is up 30.7% to roughly 133,000 active listings, and the timeline to close has stretched to about 105 days. Sales are only down about 1.5%, but liquidity is thinner and the market moves slower. What changed? The 2020-2022 boom was powered by migration, corporate moves, and 3% mortgages. By 2024, supply had doubled and affordability became the ceiling. At 7%, a $330,000 home costs north of $2,600 per month before taxes and insurance, up from about $1,400 at 3%. That monthly shock has flipped buyer psychology from FOMO to FOOP, fear of overpaying. Bidding wars are out, concessions are in. Insurance is the hidden wrecking ball. Premiums are up 20–40% in many areas, especially Houston and the Gulf. Lenders are demanding bigger escrows, carriers are tightening coverage near flood zones, and even minor FEMA map updates can freeze neighborhoods. Add that $200–300 monthly hit on top of a higher rate and buyers step back. The slowdown is punctuated by micro freezes, a hawkish Fed headline, storm-related underwriting pause, activity stalled for days. Deals still happen, but at a crawl after price cuts are sweeteners. Texas's fundamentals are intact: jobs, migration, pro-business policy, but frictions are mounting: permit bottlenecks, flood and fire regs, insurance risk, and stretched affordability. The upshot is a redistribution, not a collapse. Austin's the most stressed: luxury oversupply and tech layoffs. DFW is mixed, some north and west suburbs slipping, others steady on corporate demand. San Antonio remains the affordability leader but feels the insurance and tax bite. Houston's relatively stable with oil, but insurance weighs on the coast. Smaller cities Waco, Tyler, College Station are holding up better with remote workers and retired. Expect prices to stay flat to slightly down into late 2025, with a tentative rebound in mid-2026 if rates ease and insurance stabilizes. The scoreboard today: median price near $331,000, self-values and inventory 30.7%, about 105 days to close, sales down 1.5%. Not a crash, a repricing and a return to discipline. So what's the playbook? Buyers know your comps, your rents, and your zip level trend. Make data-driven offers, ask for credits and rate buydowns, and be patient. DOM is your friend. Investors target submarkets where buy-to-rent spreads are close or positive and where insurance is predictable. Avoid zip codes with softening rents and rising price cut rates unless you're buying at a deep discount. Sellers price to the market you have, not the one you wish you had. Pre-inspect, offer concessions upfront, and move early. You need to move. Wait is not your friend in softening areas. The frenzy is gone. Leverage is back. And in 2025, the winners are the ones who negotiate the most and let the numbers make the decision.